I saw a lot of you guys searching the how to short a stock. So I wanted to do a quick video on that for you. This is just a SPY, 3-year weekly chart. Figured this one would be a good one to look at since we had this steady climb up and we seem to be having this rapid decline back down. So if you wanted to short this stock, this is on Thinkorswim. But what you would do is you'd use options, right? So if you're not familiar with options or you're not authorized to trade options, then you need to talk to your brokerage first and enable your account for options trading. I would strongly suggest to not do margin options trading if you're new to it. But if you are enabled for options trading, you go to trade and you look at your options strikes here, and over here are your puts. This is how you're shorting stock. You could also sell calls, and that would be technically shorting a stock, but a little more straightforward is buying puts. It's basically betting that the stock will go down. So here on the S&P, you see it's the $389. You can buy in the money puts or out of the money puts. And in the money put means that the stock is already below that price and you're just betting that it continues to go lower. It's a little less risky. So here you could pay $4, right? Somewhere between $4.04 and $4.29 to buy this put, saying, hey, I don't think the S&P is going to get back above 392. I think it's going to go lower. And you'd buy this option here. You have to buy 100 of them, so it's actually going to cost you $400 to buy one at minimum, or $429, somewhere in that ballpark. Now, if you want to get more aggressive, you could buy out of the money puts, which is down here, and these are more aggressive, and they will decay faster, meaning they'll lose their value the longer that they're out of the money, right? The longer that the stock is above that price, you're going to lose money. But if the stock moves like you expect it to, you'll make more money because it's higher risk, higher reward. Same thing with the bid and the ask here. You always have to buy 100. And then this is important. This is your strike date. So your strike date is the day at which you have to sell or exercise the option, exercise the contract. So here, these are, you wouldn't necessarily buy these. This is only 1 day expiration. Today's the 19th. These are the 20th. But you can go down here and say, hey, okay, I'm going to try and here's 12 days expiration. You get a little less risky and go for 29 days expiration. Say, hey, I think the S&P is going to be below 386 within 29 days, and I'm willing to bet the $10 on that. The other way to look at this too is to say, hey, 386 minus 10 or almost $11 would be 375. So do you think that the stock is actually going to get down to 375? That would be kind of your all in if you were actually to exercise the option. So that's kind of what you're betting on. But if it gets to 386 fast enough, you'll still make money on it because there'll be more days to expiration and somebody else will be willing to pay you for the ride. So hope this helps, guys. If you have questions, please put it in the chat and I can do another video for you. Enjoy the day, guys. God bless.